Hello everyone, Clifford Bennett, Chief Economist at ACY Securities. Not a lot of data out in Asia today. A little bit weakness on the sort of consumer sentiment in South Korea. Other than that, pretty quiet day. We did see very weak data in the US, of course. We continue to see weak manufacturing, weak property data there, suggesting that, as I warned last year, we would see this year a bursting of the second property bubble in the United States this century. That may sound very odd to you because hardly anyone else is talking about it, which brings me to an interesting point. There seems to be a reticence in the financial media at the moment to talk about anything that's too negative for the United States. I'm not quite sure why that is, but certainly the US has already delivered a recession, 2 negative quarters, but people tried to say, oh, but it's only a technical recession. We've seen weakening services, manufacturing data. I know we did see a slight blip up in the services data the other day, but it was a small bounce at crisis levels, so nothing to be really celebrating. So I think the financial media has been very lenient towards the United States picture over the last couple of months, for whatever reason that may be. And I think we need to identify the fact that the US economy is really sliding down a slippery slope at the moment. We could see unemployment tick up in the United States, but it's really irrelevant at this point because jobs data lags the economy by so much in any case. But what we're seeing across all other indicators is an overall weakness to the US economy, and we are seeing negative GDP numbers. Why I'm mentioning that is if we have on top of that a property market correction. And remember, all the property data, construction through new home sales, are all rolling over rather badly to the downside. The only number that's been going up has been prices. It feels a little bit like prices are getting stretched away from a rolling over reality, and it could be that prices are the last thing to correct. So just be a little bit careful of the property market in the United States at the moment. And as I sort of have been surmising for some time now, if you get property market weakness on top of equity market weakness, all confidence will go out of the confidence balloon. There won't be anything left. So watch out for a slowing, further entrenched slowing in the US economy should property prices begin to peak. I would watch that data very closely at this point because any news that property prices fell in 1 month in the United States is going to hit consumer sentiment very hard indeed. The big news, of course, is Jerome Powell speaking at Jackson Hole later in the day. Expect him to give a lot of platitudes to the idea that he is a caring federal chairman, and he will really be keeping a close eye on any economic pain his interest rate hikes are causing. But then, so they'll be the opening remarks, and you may see some rally in the stock market on those initial remarks. But I think by the end of his speech, he's probably going to be coming back to the central game plan, which is that, of course, they have to fight inflation at current levels. The Fed is still fueling the inflation fire. It has to stop fueling that inflation fire by getting interest rates back to a more normal setting. And then even before, it can be really in the realm of restricting inflation. So still 2-3 75-point hikes ahead from the Federal Reserve, but there will be significant volatility on the day as his remarks will be spun in various headlines in different ways, probably mostly, as I mentioned at the beginning about the financial media at the moment, probably in a positive light where it can be spun that way. But I think at the end of the day, it's quite possible stocks will end up being lower. Price watchers may be arguing that all of this is already built in. That's why the stock market's been heavy through last week and into today. I'm not sure. I think we could see a momentary rally, but I think then that would be an opportunity to sell again. The US dollar remains the standout buy. If you get any downward correction in the US dollar, make sure you take advantage of that, because not only will the US dollar be strong as a safe haven for investors around the world who still feel the United States is a safe haven. I think that's a misguided belief, but that's the belief most investors have, so do respect it. And there will also be US corporations wanting to play safe and bring their money back home. That's going to be an increasing trend. We've seen bouts of that previously. I think that will be an increasing trend and incredibly important to the outlook for the US dollar over coming weeks and months. While we have seen significant upside in the US dollar, I think there is a lot more. So I remain really a Euro Aussie bear, US dollar bull, and a seller, of course, of US stocks and Australian stocks, and especially European stocks. Look, I don't want to try and be too clever here. Just really consider that Europe is most probably going into a very dark recession. So not a good global outlook, really. I could go on about China, but I'll leave that for tomorrow. I just wanted you to know with Jackson Hole, expect volatility. There could be some upside. There could be some positive spin on his initial comments. But in the end, they are still going to be hiking rates another 2-3 meetings, or even 5 or 6, depending upon future inflation outcomes, by 75 points. Clifford Bennett, Chief Economist, ACY Securities. Thank you very much.